Wall Street's quiet warnings. Is the stock market in trouble? Wall Street is beginning to express concerns about the stock market, albeit in a very subtle manner. A quiet alarm. It's important to note that no one on Wall Street has ever received a substantial bonus for alarming investors and driving them away from the market. This makes perfect sense, as Wall Street primarily focuses on assisting companies in selling securities to the public and encouraging corporations to engage in lucrative deals, both of which yield significant fees. Imagine having a market analyst loudly proclaiming that the end of the equity market is imminent. Such a dramatic warning would not only be unhelpful, but could also jeopardize the efforts of bankers trying to secure orders for an upcoming IPO. In fact, an analyst making such a bold statement would likely find themselves advised to consider other career paths. However, there is also a risk for analysts who choose to remain silent. If they notice troubling signs in the market, but fail to speak up, and the market subsequently crashes, they would face criticism for their inaction. Navigating career risks. So, what should a prudent analyst do? The answer is clear: they should issue warnings and express concerns, perhaps even raise a few small red flags, but do so in a very discreet manner. This way, if the market does take a downturn, they can point back to their earlier comments about the increasing pressures on the market just before the significant decline. Conversely, if the market continues to rise, they can dismiss their earlier bearish sentiments as merely cautious observations. Currently, with the SPDR S&P 500 ETF hovering near record highs after a remarkable 25% recovery from the lows caused by tariffs in April, whispers of caution are starting to emerge from Wall Street. Deutsche Bank analysts recently noted the pockets of exuberance are growing, while also mentioning that other measures of exuberance remain subdued. In a note released on Tuesday, analysts from Bank of America framed their concerns by stating, "While we are not observing classic signs of a blow-off top at the broad index level, certain segments of the market, such as the recent IPOs CRWV and CRCL, are displaying bubble-like characteristics." On Monday, Morgan Stanley's chief U.S. equity analyst advised clients to remain optimistic while recognizing the risks, acknowledging the presence of some recent froth in lower-quality stocks. A cautionary note. JPMorgan analysts were more direct in their recent note, stating that the extreme levels of investment in the riskiest, most volatile high-beta stocks not only pose a risk to that crowded segment, but also serve as a warning sign for the broader market, indicating a growing complacency in the short term. Clearly, those who dedicate their careers to monitoring the market are observing numerous behaviors that, for lack of a better term, appear somewhat toppy. This suggests a surge in speculative behavior that can often precede a market decline. Consider the recent resurgence of meme stock enthusiasm surrounding companies like Opendoor and Kohl's, or the frenzied trading of cryptocurrencies and related stocks, as well as the revival of SPACs. While valuation seems to be a forgotten concept, it's crucial to highlight that the stock market is currently quite expensive by traditional metrics, such as price-to-forward earnings and price-to-sales ratios. The S&P 500's forward price-to-earnings ratio stands at 22.4x, a level only surpassed sustainably during the pandemic trading boom and the tech bubble of the late 1990s. Its price-to-sales ratio exceeds 3x, also reminiscent of the dot-com bubble, with some leading stocks, like Palantir, exhibiting valuations that many would deem irrational. A personal reflection. Now, let me hedge my own statements. This is not investment advice. Expensive stock markets can continue to rise, suggesting there may still be upside potential. It's also possible that the market is accurately anticipating future profit potential before analysts can incorporate it into their quantitative models. On a personal note, I tend to see potential disasters lurking around every corner, a trait I attribute to my Irish heritage. Even when such disasters do occur, they often take a considerable amount of time to materialize. In other words, I am somewhat risk-averse and not particularly inclined to speculate. However, the recent quiet warnings from Wall Street indicate that I am not alone in feeling a bit uneasy following the recent market rally. ServiceNow surprises with earnings. Cloud software company ServiceNow experienced a significant surge in after-hours trading after announcing Q2 earnings and sales figures that exceeded analyst expectations. Their non-GAAP Q2 earnings per share reached $4.09, surpassing the anticipated $3.57, while sales of $3.22 billion outperformed the expected $3.12 billion. The company also raised its full-year subscription revenue guidance to a midpoint of $12.79 billion, up from the previous midpoint of $12.65 billion. Approximately an hour after the market closed, ServiceNow stock was among the top performers in the S&P 500, climbing over 6.5%, according to FactSet data. Southwest Airlines falls short. In contrast, Southwest Airlines reported Q2 sales and earnings that fell short of Wall Street's expectations. Despite a month of collecting bag fees, the airline's performance did not reach cruising altitude. The airline projected its full-year earnings before interest and taxes to be between $600 million and $800 million. Along with competitors Delta Air Lines and American Airlines, Southwest had previously withdrawn its annual guidance earlier this spring. After hours, Southwest shares rose by 0.2%, likely buoyed by a new $2 billion share buyback plan over the next 2 years, and the airline's assertion that recent industry demand shows signs of improvement from the depressed levels of Q2 2025. Southwest reported earnings per share of 39 cents, which was below the expected 51 cents according to analysts surveyed by FactSet, and down over 30% from the same period last year. Its Q2 sales totaled $7.24 billion, falling short of the anticipated $7.29 billion. Despite extensive cost-cutting measures since ceding board seats to activist investor Elliott Management in October, Southwest's non-fuel costs per seat mile increased by 4.3% for the quarter, aligning with its own expectations. The airline anticipates these costs will rise between 3.5% and 5.5% in the current quarter. U.S. Stocks rally on trade deal news. U.S. stocks experienced an upswing as news of trade agreements with Japan and reports of a similar deal nearing completion with the EU alleviated tariff risks. This propelled the S&P 500 to new all-time and closing highs. The benchmark U.S. stock index closed up 0.8%, the Nasdaq 100 increased by 0.4%, and the Russell 2000 advanced by 1.5%. Every S&P 500 sector ETF gained, except for utilities, with healthcare, industrials, and energy leading the charge. Lamb Weston saw its shares soar by 16% after exceeding Q4 expectations and reaffirming its cost-cutting strategy. Conversely, Fiserv was among the worst performers, plummeting nearly 14% after beating Q2 estimates, but narrowing its full-year earnings forecast. Shares of Toyota, Honda, and Mazda surged following Japan's new trade deal with the U.S., which reduced tariffs on Japanese auto imports from 27.5% to 15%. GE Vernova stock jumped nearly 15% after the energy equipment giant reported better than expected Q2 results. Other AI-related power providers also saw solid gains, as rising electricity prices are expected to be passed on to consumers. The meme stock phenomenon shifted, with stocks like Krispy Kreme and GoPro initially surging, but later losing much of their gains throughout the day. In a more positive light, Hims and Hers rose by 16% despite no specific news, driven by a spike in bullish options activity. Abivax's stock skyrocketed over 500% after announcing promising results from late-stage trials for its ulcerative colitis treatment. Hasbro shares initially jumped by 5% after exceeding Q2 estimates and raising its full-year guidance,